Welcome to this presentation. It's first I should start with the disclaimers. This is not the usual disclaimers. This is not investment advice. These are my personal opinions, not opinions of Bank of America. Also, there are very many slides. There are about more than 200. You should have them available. I think that you had them available in advance. Also, you will have them available afterwards. And I will cover some sort of major components, but then everything else is in the slides. You can ask me questions during and after the presentation. So to set the stage, I will try to describe why machine learning is actually quite useful, but not as useful as you may think in investment and wealth management, and what are the reasons for that, and what can be done to actually make it work. So first I should start with a little overview of the investment process. So I'm talking about investment and wealth management, which is essentially medium and long-term investing. Medium term means a few months to 1 to 2 years. Long term means up to even, let's say, 30, 40 years. We have retirement portfolios that may go up to that part. And there are the investment process essentially has two components. In the first component, the first stage, we actually look at the asset classes like large cap equity, fixed income, government bonds, and so on. We construct the portfolios based on those. And then we actually end up in the second stage, which is the implementation stage, where we go from the asset classes to the investment vehicles, where investment vehicles may be individual stocks, individual bonds, mutual funds, hedge funds, private equity, commodities, financial derivatives, annuities, and so on. So in terms of the applications, there are a lot of good successes for machine learning in this space. There are some areas where it doesn't work very well. In particular, the one that it doesn't work very well would be forecasting of financial time series, which are used in this space, because for me, I can only use at most daily time series. I cannot use intraday time series. And when I was on the trading side, that was different because it was much more focused on the using intraday information and also to use much more granular information compared to investment and wealth management. And that is a challenge because for machine learning, it's on one hand for us, what matters will be the medium and long-term features of the time series. But then if you have a lot of intraday data, especially short-term, machine learning is going to focus much more on the short-term features as opposed to medium and long-term. That can be addressed to a large extent, well, to some extent, but it's not that straightforward. So this is one example where traditional or standard machine learning methods are not working very well for my space. Now, situations where actually it is working well would be in terms of classification, pattern recognition, network analysis and clustering, and I will talk about it how actually this is making portfolios to be much more robust. It also works for extracting information from alternative data, from social media, company reports, for ESG investing. So there are a lot of applications where it was shown to have a nice impact. In the same time, there are also challenges that are partly due to the type of data that we have, partly due to the regulations that we have to obey. For example, for most of our clients, we have this fiduciary rule, which means that we have to put the interest of the client first, which is a very good thing. But that also means that the regulators are asking us not to use machine learning unless we are able to explain it. So this is going to be about explainability, which is much more than interpretability. And this is actually a big sort of thing to have in mind. Plus, the other part about fairness and about getting more data, data augmentation. There are these challenges which some of them are related to machine learning in general. Some of them are specific to the industry and to the regulations. It's also clear that right now and now I also want to make the distinction between medium and long-term investment strategies, portfolios, and short-term investment strategies. So there is the type of data, the type of models which are used for short-term investment strategies. Let's say the strategies that are used by hedge funds, by trading companies, are quite different compared to the type of data and models that we can use for medium and long-term investing. And that's why there are a lot of cases where there are presentations and studies showing good results for short-term investment strategies, and know that the same methods that do not work very well or well for medium and long-term investing. And also, it has to incorporate well the features of this financial time series. So primarily for us, what matters would be the financial time series as opposed to alternative data. That is becoming more and more useful in various contexts, but it is much more useful for short-term investment strategies compared to medium and long-term investment strategies. And I have here some examples of, I will not discuss many of them, but they are in the slides, and you can ask questions afterwards. Also, right now, one area which is becoming very, very interesting is to applications of reinforcement learning in investment and wealth management. And that is going to be related to a concept of goals-based investing, but also in general, how to actually make the portfolios to be much better, or at least much more robust compared to traditional approaches. Now, this is sort of, for me, a fun example to start with. So right now, because in the last few years, there are all these alternative asset classes, well, apparently wine is one of them. And so now they actually have used machine learning to be able to provide the certification for the wine quality. And actually, it was found to be a quite good match, because this is actually a classification problem. And if you have good enough data, this is going to work quite well. So this is one example where machine learning is going to work much better compared to traditional approaches. In this case, traditional approach would be using humans to do the wine rating. And there are also such good books and articles in the very recent years showing examples of successes. And this works primarily because it has this ability to incorporate nonlinearity. It can incorporate hierarchical dependencies. It can incorporate information that is available but is not used usually in the portfolio construction and management process. So this is a very useful feature that we can get from using machine learning. It's also true that we have this much higher degree of complexity than perhaps you can think of in terms of what is available, what type of information we can get, and how actually we can use it. The challenge is how to actually incorporate this information for medium and long-term investing as opposed to just for short-term investing. We can do a sort of a rollover, we can rebalance on a short term, and still it has to be incorporated into the medium and long-term strategies. And that is actually a challenge. So now, in terms of problems, well, or challenges, so you may have heard from previous speakers, and also you'll hear tomorrow on such challenges that are specific to deployment of machine learning algorithms. There are challenges that I have mentioned about our use cases, our type of data. It's also one very interesting study actually was done about 2 years ago by, well, a year and a half ago by people from Google about under-specification, which was a little unexpected compared to what was sort of the common wisdom in terms of what machine learning is able to do. And it's and then also there are more and more studies in terms of how to find out about that the model that is actually trained on a particular data set is going to work well on the so let's say out of sample. And now this is a very big reason, a very big problem, because for medium and long-term investing, what is very important is actually the ability to capture the market regimes, because as soon as you go to a different market regime, it's the model may not work well, and especially for machine learning, machine learning models, this is an issue because in many cases, the sophisticated ones can only capture the features which are available in the training data set. Now, on the other hand, the non-machine learning models, in many cases, they are actually created to be able to capture these features which are not visible, which are not available in the calibration data set. They may not capture them well, but they may have an idea about them. For machine learning, especially applied to financial time series, that appears not to be the case in many, many situations. So there are these challenges that are specific to machine learning, but also, in addition to those, there are challenges that are specific to the industry. And I talked before about regulations. In terms of data, we only have at most daily data. So we may have something around 80 asset classes. In best case, we have daily data. We have asset classes for which we only have weekly data or even monthly data. So it's actually quite challenging to use certain machine learning algorithms because they do not have enough data. In addition to that, they have to be able to handle these features of financial time series. You may have volatility clustering. You may have a particular type of distribution. You may have these market regimes. And for medium and long-term investing, it's extremely important for this to be captured. And that is challenging for machine learning. We have so now, how to address this issue of not enough data? So in the last 2 years, there is a very big effort to do data augmentation, not only to data for, let's say, short-term investment strategies, but also for data that is used for medium and long-term strategies. And the challenge there is that not only you need to produce data using proper models, but also that data has to be validated and has to be consistent with reality. So to give you an example, in the last, I think, 2 years, one of the most successful applications of machine learning was done at JP Morgan on the trading side, where because they do not have enough data, usually on the trading side, they would have like implied volatility matrix, which may be not more than, let's say, 20 rows and 15 columns. And that is not enough for calibrating good enough deep learning models. And what they ended up doing was they have augmented the data set much more, such that they can calibrate deep learning models on this augmented data set. And then the calibrated model was good enough to price and hedge the financial derivatives. Now, on the investment and wealth management side, it's a little more challenging because the main issue in the industry is how to show that what you have is good enough or not good enough. And that is, you are going to hear me talking multiple times about good enough. So what happens is that on the trading side, it is much easier to find out whether you have a good enough model or not. You are trading, you are doing it every day for a few months. You are going to see whether your model can reprice the instruments, can hedge them properly, and you can make money. Well, on investment and wealth management, that is not the case. So it is possible that in some cases, the investment professional may say, well, you know that this didn't work very well in the last 2 years, but trust me, it's going to work great in the next 10 years. Without evidence, but in the same time, you cannot say, well, not only how do you know, but where is the evidence? So the problem here is how to show to the investor that they need something that is better, but also that is going to work well in the medium and long-term future. And that's why one of those components, the market regimes, the ability to incorporate all market regimes is very important, because I have seen situations where good machine learning models actually were calibrated to data up to a particular market regime, and then they failed as soon as the market regime changed. And by market regime in this case, I mean, let's say if you think about the markets in the last 20 years, so we had a different market regime during the financial crisis, 2007, 2008. Then we had sort of a regular market regime for, let's say, 2009 to 2020. Then we had a few weeks of a different market regime due to COVID in March of 2020. And then we had a great rise in the values of the financial market afterwards. So all these are actually different regimes which have to be incorporated. There is a common approach in the industry to actually use average, let's say, correlations over the entire period. But the problem is that as soon as you are going to go to a different regime, those correlations, those average correlations are going to be quite different compared to what is actually happening in that regime. And now this is only talking about correlations which are capturing the linear dependencies. If you go to a deeper level, nonlinear dependencies, hierarchical dependencies, that is actually even more important. This is just about applications. So in terms of applications would be, we have forecasting of time series, we have classification and pattern recognition, network analysis and clustering, data augmentation, regime-based investing, ESG-based investing, and I have examples in the slides of various good cases, various successes there. Now, in terms of alternative data, so this is becoming more and more useful. It's even more useful on the short-term investment strategies, but it can be incorporated into the context of medium and long-term investment strategies. And because there is much more data available, let's say, compared to financial time series, there is much more appetite and interest in applying machine learning in this space. And actually, there are some good results, especially on the short-term investment strategy side. Now, there is also more and more attempts to try to combine this information with other information. One example that you'll see in the slides is how actually to use machine learning to make environmental ESG investing, to make it much more robust. Because right now the problem is that this ESG investing is based primarily on ratings coming from different data providers. And for many companies, those ratings are not consistent among themselves. And also, they may not be consistent with what the company is actually doing. So one good use of NLP that I have seen is to actually look at the reports and the actions that the company has, the news about the company, the social media about the company's actions, and check whether they are consistent with the ratings provided for that company. In many cases, actually, they are not. So there are very many applications in terms of classification, because this is definitely one of the most successful area of machine learning. And it's because of much more data availability, plus we have machine learning models which are specific for, let's say, text processing. We have NLP that is much better compared to what we used to have before machine learning. So there are quite good successes. There are not as many as you may think. It's still because the challenge is how to convince the senior management and also the investors and also the regulators that this is actually needed and this is going to be good enough. So one example is that because we are asked by the regulators to provide this much higher level of explainability, and for good reason for machine learning, then as soon as we say we are going to want to use machine learning, and the definition of machine learning actually is coming, whatever is included there is coming from our risk and control partners, we have suddenly a level of testing that perhaps may be one order of magnitude higher compared to non-machine learning models. Because it's actually very challenging to show that this model is going to work well in out of sample and in the, let's say, in different market regimes. So that is one of the challenges that, let's say, the hedge funds or the trading companies will not have, because they are not as, well, the regulations may not be as strong as for us. Now, for us, why this is important, because we have this fiduciary rule for the investors, and we have to make sure that we are doing the best we can for their portfolios. Now, for network analysis and clustering is one of the most not only important but also most successful applications of machine learning. And so the idea here will be to actually try to go from regular approaches, which are based on a correlation matrix, which is just capturing the linear dependencies, and even more, it is in many cases average correlation matrix, to actually go to a level deeper. So that is going to make the portfolios to be much more robust. They are going to be more diversified, lower transaction costs, because if you think about, let's say, S&P 500, where you have 500 stocks, think about a portfolio which has 500 components. If you can apply clustering and you do it in a robust enough manner, you may end up with perhaps, let's say, 10 or 15 clusters. For the sake of simplicity, those clusters may be just sectors. And then you can simply choose 5 or 6 components from each cluster. So instead of 500 stocks, you end up with 15 times 5 or even 15 times 3. And you end up with much fewer stocks in your portfolio, much fewer transaction costs, and yet this portfolio is going to be much more robust. Now, you can go one step further, or you can do it separately, and you can try to apply network analysis, because what was found out was that if you think about a network of stocks in terms of the closer the stocks to the center of the network, the more influence those stocks, those components will have over all the other components in the network. So from that perspective, one way to further improve it is to actually choose the stocks which are at the periphery of each of the network, where the network would be each network would be applied for each cluster. So this is one actually low-hanging fruit, which is more and more used in the industry. And it's also important to capture this causality that I will talk a little about later. And this is one way to do it. There is this website, Spurious Correlations, which is showing some very strange situations of just looking at, just comparing data and just getting the correlations from the data sets. You can get things like you have a very good correlation between, well, the number of PhDs awarded in the US and the consumption of mozzarella cheese. Or even more, you can see that you have situations where with the same data that has, let's say, the same 4 moments, you can create quite different data sets, and still they have the same 4 moments. So it's one other example is so we have these linear factor models for the returns, and it was found out that okay, there is a very good R square and T stat for the number of Asian elephants in captivity versus the returns. And obviously, this is a spurious correlation. But if you just use data without economic intuition and without anything else, this is this is going to be nothing more than data mining. And so that is where clustering and network analysis actually can help a lot. And it does help. It's still, there are things that one has to be careful about, because not all clustering metrics are the same. Not all clustering algorithms are the same. They have to be robust to these market regimes. And the same applies to network analysis. Having said that, it is actually quite powerful. Now, let me go to show something that is not working very well. So forecasting of time series is not working very well if I were to apply just standard machine learning. And even if I were to apply some more advanced machine learning techniques, there are very few situations where I have seen good results on medium and long-term forecasting. There are many more situations where I have seen good results for short-term forecasting using intraday data. And that is primarily because of the specificity, the characteristics of the financial time series, which we use. So I have in the slides various references on what works and what doesn't. In particular, there was a competition called M4 about 4 years ago, which actually did the following. They had like 100,000 time series from various industries, most of them daily, and they said to the forecasting community across the globe, give me your best algorithm. And what if they got about 65 algorithms, and what they found out was that the pure machine learning algorithms were ranked not higher than 25 out of those 65. The best ones actually were found out to be a combination of machine learning and regular statistical methods. And I will explain in a moment why that is the case. And that was also my experience. Now, after that, the machine learning community was not very happy with these findings. And to be honest, you can look at the codes. The applications of the machine learning done by the researchers for those submissions may not have been great. The calibration, the hyper-tuning may not have been great. So there are things to improve. However, they tried to beat the best algorithm that actually was from an engineer at Uber, which was this combination of forecasting and of machine learning and statistical. And very few pure machine learning algorithms were able to beat that. And I will show in a moment which ones. And to give you an idea how this works, so I can talk about the second best because it's even simpler than the first one. So what they did were they took 9 statistical methods, some simple ones, some more complicated, and then they tried to find what is the best combination across all time series at once. And they have used a machine learning algorithm, XGBoost, to do that. And by just doing this simple approach, they ended up doing this essentially the second place in this competition. So this is the article by, let me put it here, by Montero and Manso, the second one, the forma, F forma. It is also argued in the machine learning community that one needs to look at more than just the regular metrics. And so this is a very good point that is made here by Januszowski and others, which are from Amazon Machine Learning, that one needs to compare the forecasting methods across multiple directions, not just, let's say, point forecast. And that is important because, for example, for investment and wealth management, we need to look not at point forecast, but much more at interval forecasts in order to actually be able to use them properly. So there are some, even better, there are ways to actually combine them, but even better than that, actually to try to to apply the method across all time series at once, not for each time series separately. Because the way that why this works better is machine learning is going to be able to capture the nonlinearities for each time series, but also the nonlinearities across all time series. And that is actually going to make it better, in some cases much better. So right now, the best ones that I have seen in terms of machine learning are algorithms that I have mentioned here. One of them is NBITS. A better one is actually from the team at the Amazon Machine Learning, which is, I think, Deep AR. And you may want also to look at this SK-time, which is a very good Python package, which incorporates a lot of these methods. Now, these are applications. So besides forecasting, one can use this method for empirical asset pricing, which is specific to the industry. And there are some other applications where this actually can prove quite useful. To talk a little about reinforcement learning, so this is much more work in progress, primarily because the reinforcement algorithms were not necessarily designed for financial time series, and even the ones that were designed for time series, they are not able to handle well this requirement of medium and long-term investing. So now, why this is actually still useful? Because we have this concept of goals-based investing, which right now is much more preferred by the investors versus traditional approach. Traditional approach says, OK, I'm going to try to find the best risk versus reward portfolio. Goals-based portfolio says, OK, I want you to give me your desired financial goals, and let's say $100,000 per year in retirement, let's say $70,000 per year 10 years from now for college education for the kids, and perhaps $50,000 for vacation home, let's say in 6 years from now. So now these are goals which actually can be mapped to the reward function, which is used in reinforcement learning. And this was shown to be quite useful. In fact, there was an award that was given last year for a study done on reinforcement learning applied to goals-based investing. And the quants who did that study actually got the buy-side Quant of the Year award from Risk Magazine. The challenge is that right now it's still difficult to actually incorporate different priority levels for those goals, because the only one that I have seen is, to some extent, is hierarchical reinforcement learning, and still this is work in progress, especially when applied to financial time series. In the last 2 minutes, I will speak about, by the way, so actually, if you are interested in reinforcement learning applied to asset management, investment management, the articles by Ben Amou, the ones that I have on this slide, are actually quite good. And they are actually used at a French asset manager. So now, in terms of the challenges that I mentioned, so we have challenges in terms of the data itself, and the way to address that would be to actually do data augmentation and let me get there, actually. So there are methods to do data augmentation, which actually, many of them are machine learning, but many of them are still non-machine learning that were used for the last 20 or 30 years. And then they are becoming very useful because this is the only way that one can show not only that the method, the portfolio that you have right now is good enough, but also is going to be good enough in the near future, and even more, that you can actually have an explanation why it works. So I have in the slides, I have references for both machine learning-based synthetic data generation, but also non-machine learning-based. The challenge here is how to show that these data sets are actually consistent with reality, and are consistent with economic intuition, and consistent with what practitioners actually are thinking about those. And I think that I will be out of time. For the rest, I can definitely answer questions, and also you can reach out to me with questions afterwards. You can send me emails about this. So you can also look at the slides that I have. If you don't have the slides, let the organizers know, because you should have them.